$2 trillion. Chased one idea. Now the bubble faces reality. The boom in Bitcoin Treasury companies is fading fast. Research from CoinShares says the wave of copycat digital asset treasuries, often called DAT, has largely run its course. At the center is Strategy, the listed company that turned its balance sheet into a leveraged Bitcoin bet. In August 2020, Strategy became the first major public firm to pivot into so-called digital gold. Officially, the move was about diversifying reserves and managing currency risk. In reality, it opened the door to companies that raised capital mainly to buy more crypto. Many followers copied the Strategy playbook. They issued new shares and used borrowed funds, not to grow operations, but to expand piles of Bitcoin and other tokens. Their core business often remained weak, while their value became tied almost entirely to the price of the coins they held. At first, this model looked brilliant. During bull markets, Treasury-backed stocks traded at large premiums to the value of their reserves. Some DAT names reached valuations of 3 times or even 10 times their net asset value. Investors treated them like leveraged Bitcoin trackers with a corporate wrapper. The recent market correction has exposed the flaws. CoinShares notes that investor appetite has fallen as it became clear many of these companies have little to offer beyond volatile reserves. They lack strong operating cash flows, and their traditional businesses often generate losses that must still be financed. When liquidity dries up, those weaknesses matter. Companies with Bitcoin treasuries still need to pay dividends and interest. Without reliable income, they may be forced to sell crypto at unfavorable levels just to meet obligations. That selling pressure undermines any story of long-term conviction. Most DAT firms did not load up on extreme debt. Instead, they leaned on equity issuance. The major exception is Strategy. It carries loans of roughly $8.2 billion and has issued preferred shares with dividend commitments of around $7 billion. Together, that means yearly obligations near $800 million. To prepare, Strategy has built a fiat reserve of about $1.44 billion. That cash buffer gives it time, but it also highlights how dependent the strategy is on future Bitcoin performance. If the token underperforms for a long period, even a large reserve can start to look thin. CoinShares tracks a metric called Modified Net Asset Value, shortened to MNAV. This compares a company market capitalization with the market value of its crypto reserves. When MNAV trades above 1, the market is paying a premium. When it falls below 1, investors are applying a discount and questioning the model. During the peak, many DAT stocks traded at rich premiums. That phase now appears over. The median MNAV across the sector has slipped below 1. Strategy still trades slightly above book, with a reported MNAV near 1.16, but that premium is far smaller than earlier in the cycle. So has the DAT bubble already burst? CoinShares research head James Butterfill says that in many respects it has. The easy phase of raising capital just to buy more crypto is largely behind us. Investors have become far more selective, and simple hype no longer works. From here, the sector faces 2 paths. In the first scenario, further declines in crypto prices trigger aggressive selling by treasury companies. Under pressure to cover dividends and interest, some firms may liquidate tokens quickly, driving a cascade of forced sales and amplifying volatility. In the second scenario, companies hold their nerve. They keep their treasuries through the downturn and benefit if prices recover. In that case, discount valuations could become an opportunity for patient investors, especially if macro conditions and policy slowly improve. CoinShares leans toward the second outcome, pointing to better macro data and the prospect of lower policy rates supporting risk assets. If Bitcoin responds as it has in earlier cycles, stronger balance sheets and disciplined strategies could be rewarded. There is another twist. Companies trading at a negative MNAV, where their market value is lower than their crypto reserves, may become targets for acquisition. Stronger, better capitalized players could buy such firms and effectively acquire crypto at a discount via the corporate structure. Importantly, CoinShares stresses that the end of the DAT bubble does not mean the end of Bitcoin treasuries. Instead, the space is likely to evolve into clearer categories. One group will be speculative DAT vehicles, whose core business is secondary and whose value is almost entirely linked to token prices. A second group will act as reserve managers, using Bitcoin and other digital assets as part of a broader treasury and currency strategy. These firms look more like traditional corporates that diversify a slice of their cash into crypto rather than going all in. A third category will resemble closed-end funds that build diversified token portfolios and operate more like listed investment trusts than operating companies. Finally, there is a cluster of large corporates that use Bitcoin as a macro hedge but do not seek DAT status. Names like Tesla, Trump Media, and Block hold digital assets on their balance sheets while still being valued mainly for their underlying businesses. For investors, the message is to look under the hood. Two companies can both hold significant Bitcoin reserves yet carry very different risk profiles. Debt levels, cash generation, and governance matter as much as token holdings, especially when markets turn. As the original bubble deflates, the surviving players may be the ones with disciplined financing, clear communication, and realistic expectations about volatility. The era of easy copycat treasury trades is ending, and a more selective market is starting to take shape. For long-term investors, this is a test of how much balance sheet risk they truly want to carry now. This has been BlockBrief. Stay informed, stay ahead.